The first thing I want to look at here is the business cycle. The business cycle basically represents the downward and upward movement of the overall economy. It's a cycle that goes in phases throughout which the economy goes through. There are four general phases in a economic cycle or a business cycle. Let's run through each of those phases here. Look at what they're characterized by. Expansion or expansionary phase of the business cycle is when businesses are ramping up. The economy is growing. Businesses are doing really well. It shows above average growth, and it's already functioning at a high economic level. The basic idea here is economic activity is increasing or maintaining a high level. So the gross domestic product, the GDP, which is often used to measure which phase of the business cycle we're in, is going up, performing really well. Unemployment is going down. Business spending is up. Employee salaries are typically up. Basically, everything's awesome. The economy is doing really well. It's performing at an exceptional level. Now, at the beginning of the expansionary phase, more credit is available. Money for people to borrow, lending, right? And interest rates are low. Banks and lending institutions are confident that customers will be able to pay back their money, so interest rates are at a low level. As the phases of the period move along, interest rates begin to rise and inflation rises with that. Inflation and interest rates typically move in tandem. So it starts with the expansionary phase. You have relatively low interest rates and relatively low inflation. As the phase moves along, those things are going up. So by the end of an expansionary phase, you've gotten to a higher level, inflation and interest rates. Now the peak is basically the maximum point of economic point in an expansion. It marks the end of an expansionary phase. And then after the peak, you're going to have the contractionary phase, which is the next phase in the business cycle that we'll look at. One thing that the peak is marked by is high inflation. Usually inflation, which has been going up throughout the expansionary phase, has reached a high level by the peak phase. Expansion can't go on forever, and interest rates go along with it. Now let's move on to the contraction or the contractionary phase of the business cycle. Here, the economy is contracting. It's either experiencing slower economic growth or it has started to decline. Less money is available to be lended out. They've tightened reserves. So at the end of the expansionary phase, high GDP, employment levels, high levels of business spending are dropping now. They're in a contractionary phase. At the beginning of the contractionary phase, credit is tight and interest rates is high. Typically, the beginning of a contractionary phase is where you're willing to see the highest inflation rate and interest rate. As the period moves on, interest rates and inflations drop, and this is largely often anyways, due to things that the Federal Reserve Board is doing related to monetary policy, which we'll get to pretty soon here. So again, during the contractionary phase, we have unemployment going up, the GDP going down, trade deficits going down. Trade deficits are often widening or expanding. A couple definitions that do show up on the exam: 2 or more consecutive quarters of economic contraction. This is a recession. 6 or more consecutive quarters of economic contraction is a depression. So a typical exam question you might see, a recession is defined as which of the following? A contraction is defined as 2 or more consecutive quarters of economic contraction. That would be the correct answer. B might say 5 or 4, 2 consecutive quarters of economic contraction, right? 1 quarter. But 2 or more would be the correct answer. 6 or more quarters would be a depression. The last phase of the business cycle is the trough phase. This is the end of its contractionary phase when it reaches its low point. Typically after the trough phase, this is where the economy starts to turn around and we have the expansionary phase starting up again. Okay, so think of it as waves. When we talk about phases of the business cycle, expansion is going up, peak it's reached the crest, contraction is going down, trough it's reached the bottom, and then it starts going up again with the expansionary phase of the business cycle. So now we know the phases of the economic cycle. Let's now look at economic indicators. Economic indicators are basically what is used by economists, financial analysts, to analyze which phase of the business cycle we're in, sometimes called and how far into that phase we might be, where we're heading in the new future, and some economic indicators represents past economic conditions. So basically, these are statistics that help to predict the future of the economy, characterized and current in the current phase of the economy, or reflect past economic conditions. Leading indicators predict future economic movements that uh, lagging a lagging indicator represents a past economic condition, and a coincident indicator represents where we are right now. So let's look at detail into these. First, leading indicators. So leading indicators are indicators that tend to change in advance in the economy as a whole. That predictive power, right? So an economist will look at a bunch of leading indicators that they all seem to be indicating the same thing. They can predict where the economy might be going. So important leading indicators: housing starts, the number of new housing and construction products that have been counted within a given period of time. When housing starts are up, it shows that people have the confidence, right? They're willing to put out and put money for houses, and we've got construction crews, employment there. You've got production costs and goods and services, woods, material, brick, roofing. So it's seen as a good sign. Initial applications for unemployment, when those are down, that's seen as a good economic sign. People are able to work and earn income. New manufacturing for consumer goods, when that's up, that's seen as a good sign. The money supply, there's M1 and M2 and M3. M1 and M2, which is the money supply, the S&P 500 index. When that's up, that's a good sign. When index on consumer spending is up, that is a good sign. For the exam, leading indicators are usually the most important. They kind of make sense, right? If you're trying to, you're working, telling somebody which investments to make, it's good to know where the economy is going to head if you're going to make suitable recommendations. That's why on the exam, out of all the indicators you're going to see in the questions, mostly you're going to be asked about leading economic indicators. Coincident economic indicators, you may see questions about these on the exam as well. These are indicators that change at the same time as, and usually because of, whatever economy. So what they say is they basically measure which phase of the economy that we're in at the current moment. Important coincident indicators, the GDP and the GNP. GDP is perhaps the most important coincident indicator. It basically measures all of the goods and services produced within the boundaries of a country, a given period of time, within a given period of time. The GNP is the gross national product. It measures the production of residents of a country no matter where the production takes place. The trade deficit, the difference between exports and imports. When imports exceed exports, as they have in the United States for a while now, that's a trade deficit. When the trade deficit grows, it shows usually we're in a contractionary period. When it shrinks, so exports are catching up to imports, it shows that we're in an expansion period. The non-farm payroll, personal income levels, industrial production, and retail manufacturing sales. These are all coincident economic indicators. Lagging indicators are indicators that don't change till after changes have occurred in the overall product or economy. So to explain what a lagging economic indicator is, I like to use one of these examples, the unemployment rate. Let's think about that. What does the unemployment rate measure? It measures the percentage of able workers who are unemployed at that point. Typically, unemployment doesn't start to go up until the economy has been in a contractionary phase for a while. Businesses don't stop laying off their employees right away. They stop until the contractionary phase has developed. The economy has been struggling for a little while before they start to lay off employees. So the unemployment rate doesn't start to go up until we're in the contractionary phase for a while. In contrast, when the economy starts to expand a little bit, businesses might still be a little leery at first to rehire people. So it might take a little while for the unemployment rate to go down. So it measures an economic change during where it takes place. Basically, consumer spending, CPI, the Consumer Price Index, the price that costs to buy certain items, goods, and services in different locations across the country. The CPI is also used to measure inflation. The primary charge by banks and bank loans outstanding. These are all examples of lagging economic indicators. Okay, so now we've gone through the economic phase of the business cycle, the indicators that are associated and help show where the economy has been in the past. Now let's ask the question, is there anything that the federal government or any of its agencies can do to affect economic change? Like if we're in a contractionary phase, do we just have to sit back and let it play out? Or is there something the government can do to stimulate the economy? And the answer is yes. There are things that the federal government can do to affect changes in the economy for its agencies. Monetary policy is one. This is implemented by the Federal Reserve Board, and fiscal policy is another, implemented by elected officials. So let's look first at monetary policy. So the focus of monetary policy is to control the supply of money and credit. The assumption behind monetary policy is that the growth in the money supply, making more money available to the public, increases available credit, lowering short-term interest rates, makes it easier for people to borrow and then spend money, which can help stimulate the economy. So to stimulate the economy, the basic idea that the Federal Reserve Board, which is what controls monetary policy, tries to make more money available in an economy. Now, if there's too much money available in the economy for too few goods, chasing too few goods, that's where inflation takes place. You can also use monetary policy to try to inflate and come back against combat inflation, and so making less money available in the economy, tightening credit. Changes don't happen instantly. They don't always occur as expected, but the general idea behind monetary policy is that there are certain things that the Fed can do to make money more readily available, drop short-term interest rates to grow the economy, and there are things that the Fed can do to make money less readily available, raise short-term interest rates and fight against inflation. That's what they try to do in monetary policy. The Fed has a few basic tools that it uses to use monetary policies. And there's 4 basic tools, but there's really only 3 that are commonly shown up on the exam. And those 3 we're going to run through right here. Open market operations, changing reserve requirements, and modifying the discount rate. The 4th tool that the Fed has is to change margin requirements under Regulation D. It hasn't done that since the mid-1970s though, so it's not likely to show up on the exam. They don't really use that often. So let's focus on these first 3 here, the three right here. You're most likely to see these on the exam. First off, open market operations. This is the one that the Fed uses most commonly. It involves basically buying and selling U.S. Treasuries. So to grow the economy, the Fed will buy U.S. Treasuries from an associated bank. So when it does that, it pays the banks money, injecting money into the supply. The banks have more money in their vaults, so short-term interest rates are lowered, specifically the federal funds rate, which we'll get into here in a second. That's the rate that is most closely tied to open market operations, the Fed funds rate. So with lower interest rates, it's easier for consumers to borrow money, and the more money they can borrow, the more money they can spend, and this fuels economic growth. On the other side, if there's too much money available, the Fed can use open market operations to fight against inflation. It would do that by basically selling U.S. Treasuries to its banks. So taking money from the banks. They're giving money to the Fed by buying securities from them. They have less money in their vaults, higher short-term interest rates, cost more to borrow money, right? It's harder for people to borrow. The less money that's being borrowed, the more less money is being spent, combating inflation. So the federal funds rate is the rate that is most directly affected with the short-term operations. So the federal fund rate, is the short-term rate that's most directly affected by open market operations. The federal funds rate, by definition, is the rate that banks charge each other to borrow money. A second way that the Fed can use monetary policy, or a second tool of monetary policy the Fed has at its disposal, is changing reserve requirements. A reserve requirement is the amount of customer money that banks are required to keep in reserve at all times before lending out to another bank, and the Fed directly controls this. So to grow the economy, the Fed could lower the reserve requirement. That means that banks don't have to keep as much money in their vaults. This happened during COVID. They reduced the reserve requirement to 0. They can lend more money out for shorter term interest rates, so that would be easier for people to borrow money, not spend it in the economy when it grows. They could set it at 10% though, right? They could raise the reserve requirement. Now banks are required to keep more money in their vaults. There's less money out there. It's harder for people to borrow money and spend it because of the reserves that have to be kept by each bank, and this could decrease inflation. The final tool of monetary policy that the Fed has at its disposal is changing the discount rate. The discount rate is the rate that banks have to pay when they borrow money from the Federal Reserve. So the Fed can control that discount rate. So to grow the economy, it could lower that discount rate. It makes it easier for banks to borrow money. They have more money to loan out to their customers. Short-term interest rates are reduced. It's easier to borrow and spend money and fuel the economy. To fight against inflation, the Fed could raise the discount rate. That means it's harder for banks to borrow money from the Fed. The less money they have, the higher short-term interest rates will be, and the harder it will be for their customers to borrow and spend money, and that could help fight against inflation. So when it comes to monetary policy, the major idea is the Fed wants to be able to grow the economy. They make more money available, lowering short-term interest rates, loosening credit. If they want to fight against inflation, they cut back on the money that's available. They tighten credit, and that raises short-term interest rates. It makes it harder for people to borrow and spend money. The second tool that the government and its agencies have at its disposal to fight, combat, and change economic things is fiscal policy. Fiscal policy is basically what the federal government can do to affect economic change. Basically, the president and Congress, what elected officials do, the ideas around taxing and spending. So to stimulate the economy, Congress, the president, would lower taxes. That means that you get to keep more money in your paycheck and there's more money for you to spend, and increase government spending. The more the government is spending, the more jobs it can create. It can help to fuel industrial production. For example, the government wants to build highways. They pour money into the economy to build highways, and you need supplies to help with those highways, constructions crews, you need road crews. So there's more jobs, there's more industrial manufacturing and production, helps to grow the economy. Slow down the economy, the government could raise taxes and decrease government spending. Raise taxes, more money comes out of people's paychecks, there's less money for them to spend. Decreased spending, all that money that was being pumped into the economy for jobs, manufacturing before, is now no longer there. So you have to slow down, fewer jobs, less spending for production goods, right? That helps to slow down the economy. Okay, let's now shift our focus to analysis. So analyzing investments. So we'll look at first through the perspective of an equity investments like stocks, and we'll look at other type of analysis later on as well. So there are two basic types of securities in analysis: fundamental analysis and technical analysis. Fundamental analysis involves basically looking at the financial fundamentals of the company that issued the securities that you're thinking about buying. So looking at their overall financial health. So use of public information regarding the issuing company to make an investment decision. So the important documents that are used in fundamental analysis, the balance sheet, the income statement. Now the cash flow statement is also used. It is covered in your book and it might show up on the exam, but the balance sheet and income statement are the ones that you're definitely going to see the most questions on your exam. Also looking at new products and services the company offers and information about its management team. These are all things that a fundamental analysis might look at. Now technical analysis is its second form of securities analysis, is a little bit different. Technical analysis would basically be looking at price patterns and charting this information to predict past price performance equals future results. And then they chart this information and look for patterns within the charts themselves that they're looking at to predict where that price is going to go in the future. So they use things like price charts, candlestick patterns to tell the number of shares traded, price volatility, the changes over time on the daily, 4-hour, and sometimes yearly charts. They look at technical analysis that shows past performance. It shows where the price is going to go in the future. So a technical analyst really isn't looking at any of these financial documents that show the overall health of the company, the balance sheet of their income statement. They're looking at the historical price of the company's stock to try and make a prediction about where that price is going in the future. So a little question here: which of the following would not be used by a fundamental analyst? The company's liquidity, or its 52-week moving average. A moving average is a indicator. It's basically the average price of a security over that period of time. So the 52-week moving average represents the average price of that security over the last year. So typically what a technical analysis will do is they'll look at that long-term moving average, like the 1 year moving average, and compare it to a shorter term, like a 30-day moving average. When a shorter term price averages above the long-term averages, that's a bullish signal. So basically what I'm saying is a moving average is something that a technical analyst would look at. The company's liquidity, and there are different metrics that go into finding this out on the balance sheet. That would be something that fundamental analysis would look at. It's something that helps to show the financial health of the issuing company. That's the fundamental analysis, not the technical analysis, right? So the fundamental analysis would look at, they would look at A, but not the 52-week moving average B. So B would be the answer to this question here. So now let's look at some of the metrics that a fundamental analysis might look at when they're deciding whether to make an investment, right? So they're looking at the overall financial health of the company. And a big thing that goes along with this is liquidity or solvency. So what we're looking at here is how able would the company be to pay off its debts if it had to liquidate tomorrow or in the short term, right? You know, it has to liquidate its assets to cover its debts. How able would it be able to do that, and how much money would it have left over? That's what solvency, the idea of it is. So there's three main instruments here we have on the slide here that a fundamental analyst might use and might look at to determine the company's level of solvency: net working capital, current ratio, and quick ratio. Now the information needed to calculate these things is all on the company's balance sheet. So basically you need to know the current assets and the current liabilities. Current assets are assets that are either already cash or plan to be turned to cash in within 12 months or less, 1 year or less. Cash, securities, accounts receivable, inventory, prepaid expenses. Current liabilities are debts that are due in the next year: accounts payable, notes payable, taxes payable, interest payable, wages payable. So we're going to take those values and use them to calculate each of these metrics. So net working capital and current ratio basically use the same numbers. Net working capital is current assets minus liabilities. If the number is above, if it's a positive number, that means they have more current assets than to cover their current liabilities and they'll have money left over. If it's a negative number, that means their current liabilities are higher than their current assets and they could be in trouble. The current ratio basically just does current assets over current liabilities. So current ratios, so divided by current liabilities. So you get a whole number over that fraction. If it's a greater number, that means the assets are higher than the liabilities. If it's a lesser number, then there could be problems with the company because the current liabilities are higher than the current assets. And forced to liquidate, they might not have enough money in the short term to cover their debts and expenses. The quick ratio, also known as the acid test, basically takes the current assets except for inventory and prepaid expenses. It basically takes the assets that you could turn to cash, like immediately or almost immediately, takes those and divides them by current liabilities. So what the quick ratio or acid test is doing is measuring how liquid is the company, how solvent would they be if they have to cover their debts right now. So basically in a short period of time. The current ratio is measuring how able they would be able to cover their debts within a year's time. The quick ratio is how able would it be able to cover immediate period, quickly, right? So their immediate inventory, because their inventory they might not be able to sell off right away. If it's prepaid expenses, you can't turn it into cash as well. So that's why you do not include those as part of the quick ratio calculation. Another metric that a fundamental analysis would look at is leverage ratio. Leverage ratio is basically measuring how much of the company is financed by debt compared to how much it's financed by equity, private equity. Why would somebody be looking at this? Because companies often use borrowed money to increase the return, but there is potentially more risk involved if you're financing your operation. You might get more risk than equity. So basically the debt to equity ratio is debt over equity. The higher the ratio, the more debt the company has compared to equity. So typically a company's capital structure, which again, this would be found in the balance sheet, the information needed for this, the long-term debt, common equity. So basically the value of the common stock at par plus any capital surplus, right? When you sell shares of common stock, usually you sell them at a higher price than the par value, which is an arbitrary number. So that excess capital, so if during the IPO the par value was 10 cents and you sold shares for $20 a share, the excess capital would be the difference between the par value and the price you sold them at, and then retained earnings. So net income, whatever earnings you didn't distribute to your in the form of dividends to shareholders, and then preferred equity, the value of preferred stock, the par value of the preferred stock. These are all things that go into the company's capital structure. So the debt and then the types of equity, numbers 2 and 3 here, the debt to equity ratio. So where do we find the information that a fundamental analysis uses? So all publicly traded companies have to file financial reports with the SEC using these GAAP accounting standards. The most important documents, the balance sheet, which basically records assets, liabilities, and shareholder equity. Basically, assets equals liabilities plus shareholder equity on the balance sheet. The income statement, which is basically measuring the company's revenues over a given period minus all the expenses that it's incurred during that period, which leads to net income. And then the cash flow statement, which is basically a record of the cash flows that's come in and how it's spending that cash. So also footnotes to the above statements, balance sheet, income statement, cash flow statement, which retirement plan obligation, stock options. Granted, it offers them to employees in any contingent liabilities, such as pending legal cases. These are all things that a fundamental analyst would look at. All right, let's look at the time value of money. That's another important topic related to evaluating investments that might come up on your exam. So big components of this, present value and future value. So let's look at each of those. So present value, what is the present value related to an investment? Basically looking at future cash flows that you're going to receive as a result of having that investment and discounting them based on the market rate of interest at today's value. So present value assessment, it is used oftentimes for debt securities like bonds. It can be used for dividend paying stocks as well. So when it says theoretical value of a bond or other income producing asset, a stock that regularly pays dividends would be considered earned income producing investment. So basically the idea about present value investment is knowing you're going to receive a bunch of payments from the investments in the future. You want to discount those payments using current interest rates. So basically would tell you what the actual value of the security is at this current point in time. So the present value is basically used by taking that future cash that you're going to receive and then dividing it by 1 plus the discount rate raised to the number of periods. So for instance, if you're going to get 3 years from now, you're going to get $500 payments and the current interest rate is 5%, you would take that $500 in cash, divide it by 1.05 plus that 5% discount rate, and then raise it to the third power. So you basically take that $500 and divide it by 1.53 times. 500 divided by 1.05 divided by 1.05 divided by 1.05 would tell you the present value of the $500 payment that you're going to receive 3 years is. So future value, let's look at that one. Future value is basically telling you what some amount of money that you have today would be worth in the future, given some specific rate of return, typically market interest rates and interest percentage. So why would you use this? To help determine the issuing company is worth as an investment. Would it be worth that the investment, how much is it going to be worth in a few years' time, the one you receive right now? This is often used by bonds, knowing you're going to receive payments in the future. So how would you calculate future value? You would take that present investment and multiply it by 1 plus the discount rate, raised to the number of periods of time. So say you have $500 now, you could basically invest it at 5%. So what is the value going to be worth in 3 years? $500 times 1.05 plus that 5% rate. And then you would do that to third power. So $500 times 1.05 times 1.05 times 1.05. That would tell you the future value of that $500 investment, given that rate of return or given interest rate. All right, here's a present value example. So say you own a 3-year zero coupon bond, $1,000 face value bond. Similar bonds in the market are yielding 5%, so that's going to be your discount rate. That's the typical interest rate. What is the fair market value for this bond? All right, so using the discounted cash flow, discounting to the present value is what that means. You would take that present value, so you'd take the future cash flow to determine present value by taking the future cash flow dividing by 1 plus the discount rate raised to the number of period of times. So basically you take that $1,000 and divide it by 1.05 3 times. So it says 1.05 times 1.05 times 1.05, right? Or you could just take 1,000 and divide it by 1.05 and divide it by 1 and divide it by 1.05, divided by 1.05, divided by 1.05, and the answer you'd get is $864.30. You would take that present value, so you'd take the future cash flow to determine present value by taking future cash flow dividing by 1 plus the discount rate raised to the number of period times. So basically you take that $1,000 and divide it by 1.05 3 times. So it says here 1.05 times 1.05 times 1.05 and then put your answer in the denominator, or you could just take 1,000 and divide it by 1.05 divided by 1.05 divided by 1.05, and the answer you get there is $864.30. So that's the theoretical value of this bond. Okay, so that basically tells you what you should be willing to pay for this bond right now, given those discounted cash flows. All right, now the net present value calculation here is related to this. What is the NVP? It basically helps you determine if an investment is worth making given its discounted cash flows and its current market price. So once you go and figure out what the present value is, which we did on the last slide, you would then compare it to what its current market price is, and it would tell you whether the investment is worth making. So net present value is the amount on which an investment is calculated present value and receives fall short of its current or it's going to fall short of its current market price, right? So in the previous example, using the present value calculation method, we determined that the present value of that bond was $864.30. Now, stating the current market price is $850, so the NPV of that would be the $864.30 present value minus $850. So you would have an MPV of $14.30 plus $14.30. So whenever the MPV is positive, that tells you that it's potentially a good investment. It basically means that you can buy the bond at a price that's cheaper than its actual theoretical present value. So when the NPV is greater than 0, a positive number, that means that an investment is worth making. For exam questions, the exam keeps that in mind. So if the test asks you, should you do X or should you do Y, you do the MPV to figure that out. What does that mean? That if the investment has a positive MPV, it's one that's worth making probably. Or if you're making, give an example, 2 different investments with 2 different MPVs, the one with the higher MPV would be the one that's worth making, if they're giving you 2 examples. Now let's shift our focus to another important topics on the exam, types of risk, right? You'll probably see a handful of the questions related to types of risks. So first off, when it comes to risk in general, we get 2 overarching types of risk: systematic risk and non-systematic risk. Systematic risk is basically the risk that affects all of the securities in the market. It can't be diversified away. So basically, systematic risk is the risk that the overall market is going to go down, causing the value of investments to go down. Diversification does not help in systematic risk. Non-systematic risks are the risks that a specific investment, potentially in a specific industry, is going to go down, right? In not relation to the overall market. Business risk is one type of non-systematic risk. Now, diversification does help with non-systematic risk. Non-systematic risk is one that is specific to each investment within the portfolio. So the more diversified your portfolio is, not keeping all your eggs in one basket, right? It would be less subject to non-systematic risk. So let's look at the specific type of systematic risks. Again, these are risks that are not diversifiable. For the exam, there's 3 types. One's on this slide, and then the other 2 are on our next slide. So first is market risk. So market risk is the risk that an investment's going to lose value due to overall decline in the market. The market just tanks. Securities that you own are subject to their values going down. So diversification within the equities market does not help reduce market risk. There are ways to reduce market risk by hedging. Hedging is basically like taking a position that goes in the opposite direction of your other positions, or potentially shorting, right? Buying puts on a broad-based index like a S&P 500 index, which often represents the overall market as a whole. Whenever you have a put investment and the overall investment goes down, that put investment's value goes up. So when the S&P 500 goes down, if you bought puts, the value of your put would go up. So a hedge would be created, protection in that instance. Another way to hedge is to sell short market ETFs. ETFs are exchange traded funds. If you buy an ETF that's connected to a broader lying index, like the S&P 500 index, and the value of the S&P goes down, when you short ETFs, right, you borrow from the broker-dealer, sell them immediately. You hope the market price drops. You have to return them at some price. You sell them when the market price is higher and the price drops and gone down in value. You can buy them back cheaper at a lower price and then return the securities to your broker and keep the difference. The second type of systematic risk is interest rate risk. This is the risk that interest rates will go up, leaving fixed income securities like bonds less desirable. When interest rates go up, the market price of bonds goes down. Long-term bonds market prices are most directly susceptible to this. Short-term bond prices will go down when interest rates go up, but not as volatility high as long-term bond prices, because your money's not locked in over a longer period of interest rate, longer amount of time, right? So interest rate risk, when interest rates go up, the market risk of bonds goes down. Purchasing power risk is also known as inflation risk. The risk that inflation will devalue a bond because money won't be worth what it is when the bond was purchased. So bonds are fixed income securities. You receive the same amount of money no matter where inflation is. So when inflation goes up, your money does not go as far as it would have when inflation was not taken hold. So inflation, it generally takes place during expansionary environments. Usually during expansionary environments, the price of stock goes up, so they're better investments than bonds are. Deflation, it first occurs during an economic contraction. Bonds are usually the best choice during that period. The fixed income would go further when money is not deflated in value. And also, during a contractionary period, interest rates are dropping. So if you own a bond that has a higher interest rate or higher than market interest rate, the market value of your bond will drop. So that's a reason that during deflationary environments, bonds are considered better investments than stocks. Let's look at unsystematic risk. Unsystematic risk is a unique risk associated with a specific investment or asset. So diversification within a portfolio helps with these. So generally speaking, different stocks or different companies, you have a broader portfolio, the less subject to each type of risks, these risks you'd be subject to. Let's look at non-systematic risk now. So business risk. Business risk is the risk that a particular business or industry might face that's unique to each business. So in essence, their products becoming obsolete, more competition within the industry, poorer management, poor earnings. So the more businesses or investments you have invested in, the more you have a diversified portfolio, the less subject you are to business risk. Just because if one company is poorly managed, that doesn't mean your overall portfolio is going to go down. So diversification will help with this. Sector risk is the risk that investments in the same economic sector will decline in value. So the whole sector, for instance, the travel sector is down, right? Travel industry is all down. In general, you have a bunch of stocks in the travel industry. That's sector risk. So diversifying against different sectors across different economic sectors and not aiming too strong a focus in any one sector is a primary way to combat sector risk. Regulatory risk is the risk that regulatory laws in the industry may change and affect the investment. So there's a problem in U.S. markets. It's also known as legislative risk. Laws, regulations are passed, again, change and cut into the profitability of a company that issues securities. For instance, alcohol, tobacco, and firearms are highly subject to legislative risk. Assuming companies within those industries, oftentimes if there's laws or regulations passed that negatively impact the price of securities, that they negatively impact the ability to sell their goods and services, that's going to affect securities price. It's not the same as political risk here, but which we'll talk about next year. Political risk is the risk that the political situation in a country might change and cause investments securities issued in that country to lose value. So this is a risk associated with foreign investments, foreign exchange, right? Typically in developing countries or sometimes called third world markets. So the idea that a country ends up in a finicky situation and may be unstable, like an election, a regime change, or something like that, it could lead to further instability. It could lead to a reduction in values of the securities position that the investor is investing in. Geopolitical risk is the risk that investments would lose value caused by competition or conflict between nations over natural resources, markets, or trade, risk of terrorist or hostile action. So geopolitical events could negatively impact the value of securities. Liquidity risk is the risk that an investor won't be able to sell their investment at a fair price. So the idea that the investment might not be in high demand, so it might be hard for you to sell it, find a buyer, you might not be able to get a fair price for it. Now, this is usually associated with things that are hard to trade, like thinly traded stocks, typically not exchange traded stocks. Municipal securities are also not as liquid. Private equity, real estate, things that are harder to sell. Limited partnerships, DPPs, direct participation programs. Liquidity risk typically is not an issue for things like U.S. Treasuries, exchange-listed stocks. These things are easily negotiable, and they're typically easy to find a buyer for and don't run into a liquidity risk as much with these type of securities. Well done. You've completed Chapter 1 of our video lecture. Moving on to Chapter 2. It's time now that you go over to millionairesintraining.com and take our practice simulated exams for Chapter 1. Do all the subchapter tests and the chapter final. Keep doing these exams until you can 80, 90, or if you're serious, 100% our exams on Millionaires in Training, ensuring that you'll pass your test on the day of your exam. Keep at it, and I'll see you in the next chapter. I'm Colin Kleck, representing millionairesintraining.com. I'll see you in the next video.